show you in each of the cases how each of the technical analysis charts also would work. Okay. So I hope I can start. I'll just quickly recap from where we left last time. So we discussed what is technical analysis, and we discussed the assumptions behind technical analysis. We did not discuss the Dow Jones, we did not discuss Elliott waves, we did not discuss random walk theory. So all these things we will discuss today. Then we will go to the other charts, and then we will go to few questions that can come in the examination. I will not do the question on I will do the question on averages, like moving averages in this particular classroom. Then there's one more question on test that we will do in the subsequent class. Never tested in the examination, but we still have to ensure that we know those. It's very simple computation. So what was technical analysis? Technical analysis is a method of share price movement. Let's look at the slides and then try to read it. And our analysis should be with some kind of a concept backing. Okay, so everything that we do in analysis should have some logic behind it, right? So we will have to also look at, okay, what's the logic in which we are doing this? So we had some fundamentals about technical analysis. We said there are two analyses that I'll carry out to determine whether I should invest in a particular security or not. See, whenever I'm saying security, you'll have to understand that, okay, technical analysis can be put into any security. Okay, it need not to be on an equity share that is listed in the market, need not to be on that. So it can be any securities, but generally which security has multiple prices and all the analysis possible. See, every analysis requires some data with me. Okay, I require to have some data. When it comes to your debt, when it comes to your unlisted security, when it comes to real estate, when it comes to commodities, the number of data that is available to you is very, very minimal. You don't have so much of information available on a particular stock which is not available as listed in the market. Okay, say for example, the stock of a particular company which is there right now in your city. You don't have it listed. You might not have it listed. So a small private company or a big public company which are not listed, these particular shares, it is very difficult for me to identify what are the datas, what are the demand, what is the supply. This is very difficult to identify. It is very difficult to put in a lot of analysis on a short-term perspective. Long-term, yes, I can look into their financials. The information comes only on a yearly basis. Okay, so it's very difficult for me to make the analysis. That's why whenever we make the analysis, we will try to fetch the details of listed equity shares. That is where we have the information available. That is where we would be able to do the actual tradings of buy and sell. Okay, so that's why we are taking that. But the same analogy will go to even debt, even for the listed bonds. We still have a separate market to deal with that. We do have mutual funds. I can do the analysis there also. Okay, a lot of information available there as well. Okay, so let's look at the difference between fundamental analysis and technical analysis. The very basic differences we had already discussed. Where will I use fundamental analysis? So fundamental analysis goes with this particular structure. I first determine intrinsic value. There is a full chapter in models of determining intrinsic value. What are the concepts behind it? All these things are being discussed in a separate chapter. Then we will have to go at EIC analysis, economic analysis, industry analysis, and company analysis. We have already finished what are the factors that we will consider for that and what are the methods that we will use. All those discussions is over. Now, fundamental point about fundamental analysis is that we use fundamental analysis for a long-term perspective. I'm looking at the value of a particular share. And I'm saying that, okay, these are the financial factors that affect it. So it might go up. So if you really make the fundamental, I'm going to give you a practical understanding of fundamental analysis in today's market. If you really think through it, fundamentally, Corona is not going to ideally affect the market so much. reason, it might not have so much of bearing on the intrinsic value. Now, what are we expecting from the market right now? Say we are expecting that for the next probably 1 year, okay, for the next probably 1 year, we will not have enough demand because there are lots of lockdowns that are going on, because of which people are not consuming enough, people are not having cash flows with them, so they will reduce their demand. Okay, so demand might go really half, okay, except for certain industry it will directly go half, so it will affect the profitability of many companies. Now, when we are looking into market, we are looking into share price, but whether this price is determined based on just 1 year's profit, the answer is no. We are looking at, so whether the price also will go down by 50%, it should not ideally go down by 50%. Reason being, the real reason for us to say that is, I'm looking into discounting or determining my value based on what is my future potential. That future potential is actually for an indefinite period. So when you calculate value for today, even though today's demand for 1 year demand, it has reduced by 50%, but on the long run they are going to make profit again. So the actual impact, when you look at the value, something that you're purchasing today, you're going to hold it for a long time, the value difference will be very less. Okay, it could be 5%, 10%, that's it. But the problem happens is that if the company is not able to continue after this, and then that kind of scenarios is when they'll think, okay, what will be the changes that is going to be there on the market? How long this impact will be there? How long the economy is going to perform bad? That is where we are expecting, okay, government, I want you to come up and then give me some stimulus. Okay, let the government then step in forward and let the government give some kind of a support so that these people can survive. Okay, so keeping that understanding with you, fundamental analysis generally looks at intrinsic value and it is long term. But what if somebody wants to invest now, exit after 1 year? I cannot really look into my financials for 5 years and all that, because my investment horizon is very, very, very short. So in such cases, which analysis gives us a better picture on entry and exit? It would be technical analysis, because in the short term, I believe that, okay, it follows a pattern. What pattern? Something that it has already followed in the past will be continued in the future. So technical analysis is a method of share price movement. You can see there, based on the study of price graphs and charts on the assumption that share price trends are repetitive, investor psychology follows a certain pattern, and what seemed to have happened is likely to be repeated. So there are three things that has been mentioned in this particular definition. One is, I'm looking into charts. So technical analysis is a study of charts and price movement. We can say like that. It is a study of charts and price movement. And why we are studying that? Because we assume that share price trends are repetitive. Okay, so whatever trend it has been formed, that will continue to be formed. Also, whatever is the investor psychology associated with the trend, we have already seen some understanding on investor psychology. I told you about how market will behave, and based on market, how an investor would consider investing in a particular stock. So we discussed, okay, as and when boom market happens, there will be greed. Similarly, investor psychology, as and when he sees a chart, will also be same. Like if at all he has seen a reversal trend and the market is going down, he's going to start selling a lot. This will continue even today. Today, if he sees some indicators saying that market is going to go down, it will start selling that particular stock. If he sees that, okay, market is going up, he will start investing in that particular stock. So this is repeated. Since this is repeated, since price trends are repeated, even your investor action is also repeated, then we can actually predict how the thing that has happened in the future, how it is going to be repeated now. This is what basically we are doing with technical analysis. Now, technical analysis is not just one analysis. It is like a mixture of multiple analysis. Okay, it's almost like creating a bundled strategy. Okay, we will understand it further. There are multiple theories and multiple methods in which I can do technical analysis. Each one of it gives you an idea on how the share price movement is going to be like. Now it is upon you to decide based on multiple factors. Okay. So what are the assumptions in which we will look into technical analysis? Market value depends on demand and supply of stock. So it is the movement of stock depends upon how demand is increasing or how supply is increasing or decreasing. And there are multiple factors that affects the demand and supply. So stock price generally moves in trends which continue for a substantial period of time. So there will be definitely trends that is being formed. And it relies on chart analysis, which shows that the past trend in the stock prices rather than the information in financial statement like balance sheet and profit and loss account. I already told you, even though I'm saying that technical analysis relies upon chart analysis, the price is already discounting everything. So which means that it is indirectly, it is even covering the financial statement, profit and loss account factors also. What I was trying to tell you is that, see, now we are in the month of June. First quarterly results will come now. Now the each and every stock in the market will start discounting their expected profit in June quarter. So probably when June quarter results would come, it will come in first and second week of July. That is when the companies, listed companies, will do the review of their financials, consolidate, and then announce it to the stock exchanges saying that this is how much is the profit we have done after the review. Okay, so all your bigger audit firms, if you are associated with any of them, you would have gone for the quarterly review by now. Now, whenever you are looking into quarterly review, they will have some profit or loss or whatever ratios that we otherwise get, we can actually get it after the quarterly review. Now, as and when quarterly review is not even started, okay, before it is even started, the market will make a prediction. Okay, SBI is going to make this much profit in this particular quarter. Now, based on this expectation, who makes this particular expectation? A lot of analysts will make this expectation. Okay, so once the expectation is being made, people will start expecting. They'll say that, okay, it is expected. All the researchers will put it on public platform. Okay, it is expected to make 2,000 crores profit. Now, market will start discounting that 2,000 crores and say that, okay, now my price should be this much. Then they will start. No, that is not going to happen over a second. The moment it has come, it will start happening based on demand and supply. So if the expectation is good, they are going to make more profit. Now more people will be interested. So what happens is gradually the demand gets increased. So gradually the stock price, you can say, it is going up. Now the actual result comes in July first week. Now the moment July first week the actual result comes in, now they will compare it with what is there on the expectation. Say they expected 2,000 crores and the profit came to be 2,500 crores. Now the market is again happy because it is having more than what it is expected. Now it will again start going up. Now it expected 2,000, it announced 1,500, it will start going down. Now this is why it is not necessary that every time a company comes up with a profit, the market will go up. There are cases where the company will come up with profit, but the market has already discounted a higher profit. And after announcing the results, the market is going down. So you will have to analyze that. See, even though we are only looking at prices at moment, it is considering even the financial aspects also. Now, what are the principles that governs technical analysis? Technical analysis based on the three principles. First one, market discounts everything. We have extensive discussion on this. Even though when we theoretically look at it, like when we look at it as SFM, as a CA final paper, we might not have all these things practically tested a lot of times. Okay, we don't have. But then there are a few concepts wherein, like say, valuation concepts that when I discuss, few of these concepts gets repeated. But we will have to practically understand every information that is available on the market that governs our market understanding. Okay, so that is why, see, if you read about Warren Buffett, I discussed about Warren Buffett, right? So there's a biopic made on him, like I think National Geographic or some US based group has done a biopic wherein he himself is acting, kind of a documentary kind of thing, like the Sachin one we had in India. So there's one. It's very interesting thing to watch, and in that he says that one major factor that determined Warren Buffett to be very successful investor and financial analyst is because he reads at least 4 to 5 newspapers per day. So the most of the time he just spends scanning out the information that is available on the public domain. So he just looks at each and every information. That's how he gets that insights. Okay, how the market will behave to each and every information that is available on public platform. Because market discounts everything. Now price moves on trends. We can just look at few actual charts and then see, okay, yes, price moves on trends. History tend to repeat itself. So 3 principles in which the technical analysis is being governed. One is the price discounts everything. So the market discounts everything. The price moves on trends and the history tend to repeat by itself. Now, in this particular discussion for another 15 minutes or so, we are going to discuss 3 theories of technical analysis, how each and every analysis is being framed, and how this is going to be analyzed, how it is trying to analyze the market. Now, Dow theory is one of the earliest, which means that, the moment we started thinking about technical analysis. Now, in India, the entire financial market is only getting popular now. So there is huge potential, even for a chartered accountant to be in that industry and make living out of that industry. It's a very lucrative industry. So if someone gets into an investment banking profile, or it's not very easy for people to get into that. So there is I've tried a course called CFA. If you guys are too interested in finance, you should try that particular course. It's a US based course, but you can write the exams in India. That is something that people do to get into that kind of a profile, investment banking profile. Therein, you will actually learn about all type of investment avenues available. Like it's like SFM subject taken into 10 different subjects along. Okay, that's how that paper will be distributed. Okay, so I can give you understanding on that personally if you are interested. But then there are huge opportunities that will open up in the future for this particular industry. Especially the problem is right now also when we look at South, we have very less number of financial analysts. Okay, say for example in Kerala, you don't have many people who are actually analyzing the market. There are very less brokerage firms here. There are very less research firms here. And there are very less portfolio managers here. And very less portfolio managers who are successful and known across India. Maybe Porinju Vilayat will be the only person that Mumbai knows as a Malayali who's actually a good investor. Okay, there is no other person. So he has one firm that has been put in Cochin. So probably that's the only place that you have. But they also hire chartered accountants. They also have a lot of openings for financial analysis kind of a profile. Okay, now all of this started very late in India, but it started way back in 1990s in US, wherein technical analysis was like getting really popular. Okay, so first theory that we are going to look is Dow theory. Okay, so Dow Jones is a person who has done actually the first set of technical analysis. That's why even one index is called after him. Then we will look at Elliott wave theory. What is that Elliott says? And what is random walk theory? These are all approaches. Okay, you don't need to say that, okay, this is the method in which we do technical analysis. The answer is no. These are all pioneers who has said that, okay, these are the analysis that I have. They all have say. You will have to think it in this order. So for example, you are trying to do PhD. Okay, say for example, you're trying to do PhD. What will you do? You will start working on a thesis. So like you start working on a thesis, these people are also working on a thesis. What is a thesis? They're studying market for last 10-20 years. So if you want, you can also see. You're a statistician, so for example, and you wanted to see whether the market understanding can be made much better. So what you're trying to do is that you're trying to go ahead and then study the market in order to create some pattern. So all of these theories had come up with because of the thesis that somebody has presented. So now, say for example, Dow comes up and then presents a thesis saying that, okay, I do have three kind of trends in this particular market that I have studied, and he has named each of this trend, and he has associated movements with it, and he said, okay, in these trends, these are the actions that an investor should take so that he can make money out of it. This is the basic structure in which each of the technical analysis theory has to be understood. Okay. Now, tools we have so many tools to look at it. We have multiple type of charts, we have indicators, we have oscillators, we have averages. There are multiple tools that we will look into in technical analysis, but that's not the discussion now. Now we are discussing about few theses that people have presented. Okay, so let's look at Dow theory. It was originated by Charles Dow, the founder of Dow Jones. Okay, in 19th century. So this is the company who actually came up with this particular theory. So, and the founder is Charles Dow. See, you will find a lot of names in the entire SFM syllabus. Some of them I would recommend you to remember, because those people had very good theories, and it will be very nice for you to remember the theory also by the names. Otherwise, like, you can leave. You don't need to learn all the names of these particular persons for the examination. This is for the examination. Okay, so let's look at what is that Dow theory says. Dow theory is based on movement of two indices constructed by Charles Dow: Dow Jones Industrial Average and Dow Jones Transportational Average. These averages reflect the aggregate impact of all kind of information on the market. So basically what he did is that you will have to think about 19th century. We don't have so many things available to analyze there. You have to first think that you don't have computers available there. Okay, so you don't have the computing, the online trading that's happening there. You don't have on a click you will receive indexes, and all that is not there. At that time, you think that there is a mathematician who goes there and creates an index and says that, okay, index is the best method to analyze a particular market. At that particular period of time, if you have seen few movies based on stock markets, then you would have seen that generally. So if you have seen, there's a very beautiful movie called as Pursuit to Happiness. Will Smith movie. So in that particular movie, if you have watched that particular movie, then you would know that what broking in US meant. Okay, what stock markets in US meant. We have seen that particular street. No, I showed you Wall Street and what happens in Wall Street. So what trading meant in US is that earlier period of time, somebody would be there as a stockbroker. So how the stockbroker makes money? People should trade. Okay. Now, how people generally trade? Generally, the trades were happening through telephone. So the stockbroker dials a particular prospective investor based on their directories available, and he explains about the company. He says that, see, I have a very nice company. Their prospectus this. It's like a complete salesman job. And do you wish to purchase this particular company? And we expect that this company would make profit and the value would increase in so and so time. So he hears the information and he says that, okay, I would like to go for 5,000 shares. And then he placed the order. He placed the order of 5,000 shares and the stockbroker execute the order. This is how this particular market was functioning. Now then there was no global pattern in which people could say that, okay, now the market is going up or market is going down. That's when he created an index which was called as Dow Jones Industrial Average. And Dow Jones Transportation Average. So what he has done is that he has created an index based on multiple stocks. Okay, and he said, okay, you will have to analyze this particular index movement, then you can actually see how the market is performing. because it is discounting every information that the broker has given, that is available in the market, that's through the that is available through the newspapers. So this is how he has said that, okay, we can actually make a chart and then try to analyze. We can actually analyze the trend of the market based on indices.